welcome. Good morning. It is 6 a.m. on March 6th, half an hour before the market is set to open. It's a little dark, isn't it? Give me 1 second. There we go. We had quite a day yesterday. I didn't get to do the post-market analysis, so let's mix it up a little this morning. Let's not start with not with futures, but with a quick look at an overview of the indices before we take a look at the futures. So we'll go over here and take a look at our SPY. So yesterday we were talking how it was unlikely that we would get a move upwards, that we would have a lower close than the previous day, and that we didn't really expect this to get probably much below the EMA 8. So yesterday it got really directional. It did get below the EMA 8, but we closed back up very close to the EMA 8. So the precise words that I said were that we would get, it was possible that we would get directional intraday, but we would not get meaningfully directional on a day-to-day basis. And that was true. We got very, very, very directional intraday, but on a day-to-day basis, this is down, but it's only really down to the EMA 8, which is not much to be concerned about. That's completely normal. Even an EMA 20 would be normal. So if we look at this trend, the entire trend, we come over here, we bounce off the EMA 8, we bounce off the EMA 8, we bounce off the EMA 8, we bounce off the EMA 20, EMA 20, somewhere in between the EMA 8 and 20, then the 20, then the 20, then the 8, and now we touch the 8 again. So yesterday's movement, while it may have seemed really large, and on a 1 day close to the next day close, it was on the somewhat larger side, you can see that it was only 1%. It probably felt a lot more extreme than it actually was. Look at this day, that was down 1.38%. This day was down 1.63%. This day was down 1.39%. This was 0.78. So you can see that a 1% move is actually normal. It might have felt extreme because there is a lot of anticipation built up in these markets and perhaps within ourselves that, hey, we're going to pull back, we're going to pull back, we're going to pull back. And that might have felt like this pullback, which is probably why we traded down and kept on going down. But it's not a big deal on the day-to-day time scale. So we don't want to get confused. We don't want our feelings to dictate how things are going. We want to be able to have context so that our context can guide those feelings. So we're really just down just a tiny bit below the EMA 8 today. If we bounce back up, then it's entirely possible that this time is just a bounce off of the EMA 8 rather than EMA 20. We're already getting a little bit of a clue right here with the pre-market at 510.19. You can see that yesterday we opened at 510.24. So just from the opening, just from the overnight movement, we completely undid all the loss during the session. We haven't made up the gap, but we made up the entire session just from the overnight trading. So it is very possible that we come and we fill that entire gap today and maybe even push higher. So it is very possible for a recovery and a bounce off of the EMA 8 today. Is it likely that we're going to move down and challenge the EMA 20? Not too likely, given that we're opening up again at 510.16 or 510 in that same range that we opened yesterday. And if we couldn't do it yesterday, then we're probably not going to do it today, with the caveat that unless Jerome Powell says something really crazy, because we do have the beginning of the testimonies today. So and I don't imagine that Jerome is going to say anything crazy. He's very careful. He was just trying to keep he doesn't want to be painted into a corner and be held accountable for something that he says. He says, hey, we're going to lower rates, and he ends up not lowering rates, then he doesn't look so great. So he's probably just going to be doing what he's been doing, which is we need to look at the numbers. We need to wait for the data. And as long as he does that, we're not going to come down and challenge the EMA 20. Very unlikely. So why would we get the type of action that we saw yesterday? normally what happens is the institutions, they can see where all of people's orders are. They can see where stop orders are. And we can also, if we subscribe to level 4 or even level 3 data, it's expensive, but it's there and it's available as long as you're willing to pay for it. So if we can see where all the orders are, or there's a large group of orders, then what can happen is, and usually it's algorithms, it's not a person sitting there staring at it. All institutions have to do is come up, just say we have a lot of sell stops. So we're right here, we have a all-time high, and people are getting nervous. They're anticipating a pullback. And so a bunch of people put in a sell stop, let's just say 1 ATR below this open right here. And overnight, we gap down pretty close, probably, to 1 ATR. Let's take a look. On that day, the ATR was 4.13, and the low was 512. So if we gap and we hit 508, then it's possible that we trigger a bunch of those sell stops. And a lot of people in the retail space, they're not able to watch the market all day like a professional can. So they're just putting their order there and saying sell stop. Well, where's 508? 508 is right there, 508, okay? And it also happened to be the same level as the EMA 8 that day, exactly 508. I don't know. You're going to have to look in the top left screen because if I move my mouse, it's going to disappear, but it's exactly 508.00. So if we trade down and we say, hey, algorithms start pushing our prices down to that 508, exactly that EMA 8 level, and yesterday, intraday, that's where we put our line right here, this line right here. Ignore these bottom two. We said that 508 was the EMA 8, but the EMA 8 would be a little bit higher as we opened during the day, but we left it at the 508. And if we go below, then we trigger, let me get rid of these bottom two. Okay, so what happened? We traded down 508. It held for a while. We traded below it, but we came right back. And then we traded below it again, and bam, we had this sell-off. And then we recovered. So once we trigger all those stops, then we have a waterfall downwards, and then institutions start buying it back up. And so everyone who had their stops at 508, they get washed out. Here, it started to get washed out, but then we recovered some. Institutions start buying it up, and then we challenge it again and again and again until finally we wash them all out. So all of this movement downwards is trying to trigger those stops, and then the institutions start buying it up unless they are willing to let it fall even more and try to capture it at an even lower level. Right now, it did not seem to be the case, right? This movement upwards in the last, 20, 30, half an hour, in the last half an hour, where it moved higher and upwards, that's institutions buying it up and say, okay, we've have enough of a bargain. Let's bid it all the way back up. So, and that's on a micro scale. That's only on an intraday basis. The same thing happens on a daily and weekly basis. So right now, we're not at that point yet in the market where we're seeing enough accumulation of stops for us to see it on a longer time frame. But the fact that we came down and well off the lows yesterday, that's strong upward movement. And it's unlikely that we have the same number and level of stops at the same level today because they all got wiped out yesterday and are, oh my gosh, what are they going to do? They're going to either be fearful that we're going to continue lower. And then, so either there's some more buy stops lower down here, or the institutions are ready to go up and make this run up. And given that we're opening similar to the level where we opened yesterday, the chances are, but it's very unlikely that we're going to get a red day, basically, because of where we are, because to get a red day, we have to be below 507.18, and we're already up at 510.2. So for us to get that red day is really, really unlikely. If I looked at the I might as well look at the futures now. Whereas, yeah, and so you can see that on the NASDAQ, we're up almost 1%. That's crazy. On the Dow, we're up 0.5%. On the S&P, we're up more than 0.5%. It's like 0.6. So it's going to be very hard for us to have that red day today. There's a lot of pressure and a lot of momentum to the upside. So can we challenge the all-time highs? Maybe. If the market's really strong, it probably would take something crazy said by Powell again for us to get that high. And so what this is really is just, let's look at just the context of right here. That's just sideways movement. Just sideways movement. As long as we're trading in this box, or the top or the bottom of this box, is just sideways movement. Where? Along the psychological resistance number 2. So everything we were talking about last week, and maybe even the week before, where we said, okay, the psychological resistance is probably going to be pretty strong. And given that we didn't see a lot of pressure to the downside, the most likely scenario was that we were going to chop sideways until we finally run out of room to chop sideways and either break up above the psychological resistance or down through this downtrend. And so far, that's what's happening. Yes, it looks like we poked above the psychological resistance, but remember, I wish I could make this bar super fat. Nope. That's the most I can do. I wish so. I would span it from 510 to 515. That would be a region, not a line. So maybe I can represent it this way. So psychological resistance to upper. Okay, and this would be the lower. So we'll just consider all this region between these two red lines, the same zone, the same psychological resistance. So as long as we stay in here and we keep chopping sideways, then, and you can notice that that's pretty close to the all-time high. So basically, if we make another all-time high above this top line right here, then we have potential to move upwards. Until then, we're just going to consider that sideways movement until we get squeezed in between these two and we pick one direction or the other. So far, just sideways movement. Jerome Powell does have the potential to send the market either above or below, more likely above than below. But actually, we're kind of halfway in between those two. So we'll see. Most likely, anything that he says would cause us to challenge either the upper or lower bound, not actually break through. And we would need to see follow through for the rest of this week for us to actually be convinced that something has been broken. So that's the picture on the S&P 500. It's very likely going to be the same thing on the Dow Jones and the QQQ. QQQ, we came in when we touched that EMA 20 and bounced up. So same thing is the QQQ, touch the EMA 20, bounce, go a little bit below the EMA 20, bounce, EMA 20, bounce, EMA 20, bounce, EMA 20, bounce, a little below the EMA 20 bounce, now touching the EMA 20. So the QQQ hasn't taken the EMA 8 as a Q at all. It's been bouncing off of the EMA 20 or just below it. We've had a couple of head fakes. So now we came and we touched the EMA 20. It looks like we're going to open just below where we opened yesterday. So it's just really the same story in the QQQ. If we had hedges, right, we did the QQQ hedge the other day, we examined that, and that was designed, hey, by the end of the week, if we touched the EMA 20, then we would have doubled. Well, we touched that EMA 20 several days before the end of the week. So that particular option would have more than doubled, maybe like 250 to 300%. So now that it looks like we're going to bounce, I would be taking those hedges off because this bounce would undo a lot of that profit. So, and same with the VIX. We had a VIX trade up here, and you can see it's down tiny bit. So I would just close the hedge. You don't need it anymore, given that it's very likely that we're going to stay up here for at least through today. If you want to say, hey, well, what about Powell? And he might throw us down. But again, based on what we were looking at in the S&P 500, he might put downward pressure, but that downward pressure would just put us back at the line. And then once we're back at the trend line, then you would put on your hedge. Now, right now is a little too early to put on your hedge. So I would wait one day before putting back another hedge and deciding whether or not to put on that hedge. Just because if we just go back up, then you don't need a hedge for a while. There's no point in decreasing your profits. So QQQ is following the same pattern as SPY. You look at the Dow Jones. Dow Jones, similar, except it actually broke below the EMA 20 and stayed there. So this is actually a lot weaker than both the SPY and the QQQ. But again, we've come and bounced off the EMA 8, 20, came a little below the 20, and then came back up, 20, 20, and now 20, a little below the 20 again. So we don't want to freak out yet. We would want confirmation. And like this day, we didn't get confirmation. It just went right back up. And today, at our open, we're going to open above the EMA 20. So should we freak out about it? No. At worst, we'll just span the EMA 20 again today. And there's no possibility of that bar being completely below the EMA 20, given where we're going to open. So there's not too much to worry about yet in the Dow Jones, just the awareness that the Dow Jones or the blue chips are weaker than the tech. So one thing that we might want to look at, let's quick look at IWM. IWM back down into this region, although at the open looks like we're going to challenge it again. And then let's look quickly at bonds. Bonds went up yesterday, and so not in the same direction as the market. So that's not, so they inverted, but that's just for the day. I want to get too excited about that. Down a tiny bit on the open. So all the movement yesterday was disassociated from bonds, or at least I shouldn't say that, because the normal relationship that we see between bonds and the market is they're inverted. Bonds up. So we see bonds as a flight to safety mechanism. So when people freak out, they go out of the stock market and into the bonds, which is actually what sort of happened yesterday. But we haven't been operating on the classic movement. It was if TLT can move upwards, then QQQ can move upwards. That's the pattern we've been seeing ever since we had all this inflation stuff from COVID. So yesterday we reverted back to old patterns, but given that we're still in that same inflationary environment that was caused by COVID, I wouldn't expect this to keep on going on. So we may move higher on TLT, but TLT is going to be completely dependent on what Powell says. It's direct impact on what Powell says. So we'll watch carefully what happens to TLT. That could give us a clue what will happen to the major indices. And we are about to look at sectors, and then we'll end this because I've been talking for a while and we want to be able to get ready for the open. So we'll look at our sectors, and I want to see how fragmented sectors are given this pullback. Not even like mild baby pullback into the EMA 8 for the SPY. So really just sideways movement, but it is a pullback from an all-time high down back into the EMA 8. If that was enough to shake up or realign the sectors, then this market is really strong and we can expect upward movement. But if it had no effect and we're still really fragmented, then we still need a major pullback in order to fix it. So when we look at our sectors on a longer term basis first, we've got tech and QQQ communications all right next to it. SMH, K, QQQ, C. That is a normal relationship. I've got F, I, Y. Y is not a normal relationship. B, V. Okay, so what was it the day before? A, C, F. Okay. Y was way down here. Let's look on a 3-month basis. Y way down here, C in the middle, K up here. Look on 1-month basis. I, B right next to each other. Y, K right next to each other. R, E, V. And then where is that? Oh, F right now, all right next to each other. U, C way down here, which is a little weird, but on a 1-month basis, we're not too bad. We are a little bit fragmented, but not that bad. And then let's just look on a 1-week basis. P, V, E, Y, and C are way down here. F. So we got a little bit of fragmentation, but not nearly as bad as what it was earlier. Especially on this 1 month. 1 month is actually looking decent. Not great, not perfect, but decent. So I would say that the likelihood of an imminent downward break below the trend line is less likely now. So over the weekend, we're about 50-50 in the next 2 weeks. Then given the move on Monday, we moved to about a 60-40. But what we're looking at about right now, because of the strong bounce off of the EMA 8, at least what's looking like it's going to be a strong bounce off the EMA 8, and what we're seeing in the sectors. And let's take a quick look. We didn't look directly at VIX. VIX is down, still elevated, but down from yesterday. And CPC or above 1. So a lot of puts came into the market yesterday. They're probably going to get wiped out. So I would say that I would be flipped the other way now. Instead of 60-40, probable that we'll get the pullback below the trend line. Now we're about 60-40 or maybe even 65-35 that we're going to continue upwards. The break from this box will be upwards rather than downwards. But we're still looking at a 2 to 3 month time frame. We didn't look at that in particular. We will do it in the aftermarket session, but I'm pretty sure that picture hasn't changed, and we're still going to expect that larger pullback or correction in the next 2 to 3 months. All right, so we're only 5 minutes before the market open, so we'll go ahead and stop the session here to get ready for the open. Have a great day, guys.